question, which is, how do I use IBC and cash value life insurance when I'm in my 20s and perhaps I don't have that much cash flow to start off, or maybe I do. Here's really what we want to go through. So IBC, whether I'm in my 20s or any age, is a couple things. IBC does what? Teaches one how to use a policy as a financing tool. I've got the ability to borrow, repay, use the funds very similar to a line of credit. The cash value's liquid. I also have a death benefit too in my 20s. In my 20s, I might say I don't really need it or want it. However, I do have a sizable death benefit that will last indefinitely, which is nice. But again, IBC, how do I use the money? Now, here's the most important piece, which we touch on all the time. We're going to put an extra layer in here. So we've got policy design. Where can my money go? Premium, which we'll also refer to as what? Our insurance expense. And then two, our PUA rider, which is premium dollars as well. We'll often refer to as a cash dump in, money that we can allocate directly into the cash value. Go on board. Thank you. So, with those two areas, what do I want to be aware of? The relationship. Quick recap here. I've got cash value and death benefit with a life insurance policy. Dollars I pay towards the premium, often relative to my cash value. What do I see in the beginning? When I say beginning, I'm specifically referring to the first and second year. Sometimes only the first year, depends on the product. Premium dollars, I see nothing show up in cash. Again, years 1 and 2. The reason why, base premium dollars, insurance expense dollars, first and foremost buy me a death benefit. Let's say it gets us $50K. The life insurance company overcharges me for the death benefit up front. Versus PUA dollars, i.e. cash dump-ins. The company will refer to this as premium dollars as well. It technically is a premium because it does buy us more death benefit. Say it's $1,000 a year I pay in. Say I'm in my 20s, that might get me another $4,000 in what's called paid up additional life insurance. The benefit though here is if I pay $1,000 in, I'm going to see very close to $1,000 show up immediately. Those dollars are accessible. Those dollars begin to yield the guaranteed return, begin to yield dividends immediately. This is the key to beefing up the cash values quickly on a life insurance policy. So the main thing, if I'm in my 20s, make sure I'm going to put this word here, understand the policy design. And why I'm saying understand it. Because in my 20s, what I would say in my 20s is I didn't have the money to put in $10,000 or $5,000 a year, couldn't do it. So if we show an illustration to a 20 or 25-year-old with, I don't know, 30 grand going in, they say, hey, these numbers look great, but the 30,000 might not be attainable. 3,000 may be a struggle. Whatever the dollar figure is, if I understand though the policy design, this is critical. Reason being is we can design a policy where I can have, call it a minimal premium, and the ability to enhance it over time. Pardon my sloppy handwriting. So I can commit to a lower scheduled premium, set my MEC limit where I need it. We're going to go through that in a minute here, but have the ability to add more funds into cash as time passes. So let's clear this out. So we touched on policy design. Check mark 1. Wherever I have my premium, got my PUA rider as well. We're going to call it cash. Limitations there. If I have my premium at $1,000 per year, often, and this will depend on the company, but this is very possible, we talk about this all the time with our 1090 split. It means I have the ability to add another 9,000 there. Some companies will let me add another 10,000 there, 10x in PUAs in addition to the base premium, which is great. Main point being is I can often contribute up to 10x that base premium in PUAs per year. To do that, I do need to make sure I set my MEC limit at the appropriate number, which we're going to touch on when we look at an example. The other check mark, company selection. So when I look at the carriers out there, companies that have consistently delivered the highest actual returns, not just projections, where we have consistent proof thus far. And if you've watched some of our videos, you're probably sick of hearing me say this. But if you're new to it, that's why I'm putting it here again. 4 major mutual companies. So we've got Mass, Guardian, New York Life, and Northwestern Mutual. Regardless if my goal is IBC, if I just want a whole life insurance policy for the death benefit, maximum cash value, what we've seen is top tier quality, massive size with these big 4, but they have consistently delivered, from what we've seen and all the proof out there, the highest actual cash values. So if my goal is to use the policy, whether it's for retirement income down the road or if it's to use for the borrowing feature, if I maximize my policy design and use a company that has consistently delivered, what does that do? It gives me more cash value, a greater monetary value that I've got access to use the money now for other things. It'll also beef my death benefit up over time as well. Not to say other companies are bad. We're working with a couple right now and obtaining some proof that the performance may exist out there, but for now we still have these guys and a lot of proof. So what we're going to look at next is an example of a 25-year-old male. And in this policy, we're going to look at one of the 4 major mutual companies. Let's just call it Big 4. And the policy design. Oops. Here's what we're going to do. We're going to have a policy that is equipped with the following. We have a minimum premium of $1,000 per year. I'm going to put this in here. A term rider that is under $250 a year, meaning the total scheduled outlay is going to be $1,250 a year, or that's a little over $100 per month. So here is a prime example of a policy where I can commit to the minimum. I don't want to have a burden. I'm in my mid-20s. I'm trying to get things going from a financial perspective. I don't want to have this bill come every year that I can't pay, or I'm stressing out over it. So we're going to design a policy where I'm committing to a minimal amount. And we can set the minimum lower than this. Why we have it at this number is, key point, I've got my base premium at $1,000. This is why we touched on the policy design segment earlier, is what's the maximum I can pay into the policy per year if I have a $1,000 minimum premium? Know what it is, Jada? $10,000, 10x the base premium. So I want the ability to add money into the PUA rider. Cash money dump in of up to $9,000 per year. So again, minimum commitment with the ability to pour in more cash. This way, I can utilize the policy over time. I can pay up to $10,000 as the years pass. I also have the MEC catch-up contribution rules that I can take advantage of. The main point is I'm starting young, I'm getting in early, and as my income increases, as my situation improves, I can add money to the policy. I don't have to start all over or start when I'm older. My health changes. I can get in at a low amount and add more to it. Doesn't mean I have to. If I'm more comfortable starting older, I can do that as well. But we're going to specifically address the question here of someone in their 20s starting a policy. Let's take a look. So a couple things here. Actually, we can do it right on the board. Under our policy design, we've got a 25-year-old male. 25. Regular preferred, so we're not going to even go the top class. We'll put it in the middle of the road. Down here, actually, let's hit calculate first so we can see everything. In the policy design, we've got our minimum premium set at $1,000 per year, and surprisingly, a clean death benefit of $500,000, since we usually have oddball numbers. Why we have it at 1,000? So let's navigate through this. Here's my base premium, $1,000. That's my minimum underlying insurance expense, which purchases me here a whole life death benefit of just over $100K per year. That's our actual whole life policy for a 25-year-old male when he starts the policy. Now, the net death benefit down here is $500K. How we did that is we added a term insurance rider to the policy. Here's the cost of the term rider as well. It's about $186 for the first year. Now, why we have the term rider, in case you haven't seen segments on this in the past, is this is a cheap or cost-efficient manner to raise the death benefit, which raises my MEC limit. So total death benefit of $500. Follow the red line. 7-pay premium, $10,935. So we overinflated it a little bit. We can set it wherever we want, but this is my MEC limit. Just over 10K. So I've got my limit set up where the company allows me to 10x my minimum premium. The IRS allows me to pay up to that number per year. So I now have a policy where I'm committing to a minimal amount with the ability to add more funds at my leisure. And the right riders must be set up and able to be able to do this, in order to be able to do this. So here's my net premium, or a net after-tax outlay, $1,250 per year, $1,250 per year, which can be paid yearly or broken up over 12 months, however we want to pay it. That's what's going in. From a cash value buildup standpoint, this will not look good at all because we're paying just the minimum premium and we have a term rider attached that we don't drop until year 20. But to look at it, by age 40, I've paid in 20 grand and I have $16,660 in cash value. Not that attractive at all. I do have a death benefit, so if anything happened, I've got that legacy planning. But I'm only 40 years old here, still very young. The purpose to setting up a policy like this is, even though that cash value is not that attractive, if I look at it year over year, I'm paying in $1,250, I'm getting about $2,000 back, a little bit less. This is with minimums all the way through. So the question is, I started very young, I got over the initial insurance expenses in the beginning. What's the advantage? Well, the advantage is really if and when my income increases, adding more money to an existing policy that are over the expenses is going to reap greater cash values, a higher monetary value, than having to start all over and go through those initial insurance expenses again. Let's demonstrate here. So we're going to copy this guy. And here's what we're going to do. We're going to go into the Policy Design tab. Where's that calculator? Let's use our fancy technology. So let's assume in the first year we don't pay anything extra in. So in case that wording is small. It probably is for the camera. It reads unscheduled PUA payments. Companies' flexibility provisions and how we set it up is critical here. Some companies let us throw it in whenever we want. Other companies is once a year. Some have rules and such. Main point, be familiar or make sure your agent is familiar with this. Let's, how much you want to throw in year 2? Say I got a bonus at work. I want to throw in $3,000. Let's assume the next year I threw in nothing. We're going to have to specify each year, but that's perfectly fine. And let's throw in here $5,000. Years 4 through 7. And we'll go 10. Years 8, 9, and 10. We can make this whatever we want. Here we go. All right. So policy design, this scheduled payment here is the exact same $1,250 per year, whether we are paying that monthly or yearly. And then we're going to start throwing extra payments on top of it. So what you'll see, year 2, we paid an extra $3,000 on top of the $1,250. $1,250 was the scheduled payment, dumped in an unscheduled PUA payment of $3,000. Just about all of it showed up in cash value. Next year we paid a nothing, and then an extra $5,000, and then an extra $10,000. Real quick on this point, on the 10, payment there per year is $11,000 per year total. What's my MEC limit? $10,935. We're over that. We're not triggering a MEC though. If we did, you'd see it in bold on this illustration all over the place. The reason we did not do that is, remember, the MEC limit is a cumulative number, meaning unused MEC space or MEC dollars will roll over year to year. So for example, if I pay in $2,000 one year and I've got a MEC limit of $10K, I could have paid in another $8,000, but I did not. So what happens is that $8,000 of unused MEC space rolls over to the next year, resets at, call it $10K, plus the unused $8,000. Any unused MEC space compounds on itself. So now it's $18,000, we'll continue to do that, and I can make catch-up contributions to make up for lost time. Very valuable to be aware of that. So here you see payments going in through year 10 at $11,000, and then back down to the $1,250. What's happening here though, as I'm paying in 11, does it make sense to add $11,000, an extra 10, policy year 8, or start all over and go through the expenses again when I'm 32 years old? Later on, add to an existing policy. I pay an 11, grows by just about 13 there, so I get that 11 back plus another 2. If I want to keep going, I can easily do that. Unscheduled payments, let's say that goes through 12 years. As this goes up. So there I am in year 11, make another payment there. Cash has grown quite nicely by about 15K, where I've paid in $11,000, getting more and more back than what I pay in. In addition to this, what I can also do, so we paid in the max fund through year 11 there. I love this software. Is let's stop all the payments after year 10. So a 25-year-old decides, hey, I started the policy, wanted to pay into it for a while, I've added some extra funds, I've got other stuff going on now. I want to stop paying altogether. Even though this particular product is paid up at age 99, meaning the premiums are due up until age 99, we stop payments 100% after year 10. This will work on the guaranteed values as well, meaning if we exercise the reduced paid up, there's no chance of having to deal with premiums down the road. Cumulative after-tax outlay, I've paid in just under 65. Cash value is about 69. We took our time funding it, took some time to build it up, but it is on autopilot at this point in time. We pay nothing in thereafter and continues to grow. As far as using it for IBC, as far as borrowing, repaying, taking income out, I can do that exactly the same as I would if I'm 40, 50, or 70 years old. That does not matter. I also have the added value of the death benefit over time, which if I'm 25, maybe I don't have a wife and kids yet. When I'm older, I may. Now I've got life insurance there. Even though I took this out for the cash benefit, now I've got the death benefit to complement everything as well. Hopefully this was helpful as an education segment. More to come in the future.